everyone, and a very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. This is the show where we get you all the latest news and updates around your personal finances, ensure that you are on the right path for wealth creation, and of course help you spend all that hard-earned, invested and earned money as well wisely in our Spend with TMS segment. So let's tell you what we have lined up on the show. Remember, since last week we've been talking about where The Money Show will be focusing in the year 2021. Diversification. If 2020 was the year of risk-taking, 2021 is the one for diversification. So we will be taking forward that conversation. And in our Spend with TMS segment, well, guess what? The fares given by Indigo and SpiceJet have been extended once again, the discount period, for the fares. So the question is, should you really be jumping in the bandwagon and opting for all of these discounts? I have Ajay Avtane with a very different view, and guys, I think you should listen into what he has to say. In just a bit from now, I will go across to him. And we will also be talking about gold, because markets have been staging a very strong rally. So should you etch your portfolio with some gold? We'll be bringing on board Harshvardhan Rupta as well for that. But first up, let me go across to topic one, and that is diversification. When we build a portfolio for ourselves, we usually fill it with fixed deposits and, maybe equities as well. But it's important, and especially in the year 2021, that you have a good mix of different assets. When I say assets, last week I spoke about foreign investing, and this week I'm going to speak about corporate bonds and corporate fixed deposits. The difference between a corporate FD and a normal FD is that this one is issued by a particular corporate. So it could be a Power Grid, maybe an NTPC, it could be a Muthoot Capital, any NBFC for that matter. And a corporate bond is as well a bond, a fixed income security issued by these corporates. However, in a corporate bond, you usually need a large ticket size. So may not be suitable for all kinds of investors, but definitely if you have the appetite for it, this could be a good product as well. And the reason why I say this is because these instruments actually have a better return compared to, your bank FD. If your bank FD has a rate of roughly about savings account has a rate of 3 to 5%, and a corporate FD has a rate of 6 to 8%. In fact, a AAA rated corporate FD. It has its own set of cons as well. The key one, of course, being concentration risk. We know what happened about 2 years ago with DHFL, with ILNFS. Unfortunately, so many people had their money, which they had deposited in DHFL's corporate deposits. And when the company went down under, those deposits were not returned. So let's essentially understand how these products can help you diversify your portfolio, and are they good instruments to diversify your portfolio. I have with me Raghvendra Nath, MD of Ladderup Wealth Management. Mr. Nath, thank you so much for joining us today on ET Now. It's a pleasure having you with us. And so to start with, let's start with the question that I just brought up. Diversification is, of course, extremely important. I'm sure you as well advise that to your clients. Do you think that adding corporate bonds and corporate deposits are a good way to diversify one's portfolio?
Yeah, so, Mubina, in India, most of us love assured return instruments, and we have been used to very high returns in the past, and from fixed deposits or post office schemes. And we continue to basically, and typical Indian investor is continuing to hunt for higher yields on his investments, and which he can basically get on a fixed basis, in a short return kind of thing. And that's where probably corporate bonds and fixed deposits of corporates can come of use, because in today's environment, the way interest rates, and as you were rightly saying, that interest rates have come down sharply in the last 1 year. The SBI is now giving something like 5.4%, maximum interest on a fixed deposit, which could be 5 years or more, and maybe 1 year back it was around 7 or 8%. So in this kind of environment, yes, people can start looking at corporate bonds and fixed deposits, because like banks, there are good banks and average banks. There are also good corporates and not so good corporates. So if you are basically putting your trust in some of the best corporates of India, probably you can actually diversify and get higher returns and also keep your money safe.
So let's understand the why is it that these corporate FDs and corporate bonds tend to give you a higher rate than bank FDs? So if you could just explain that concept first to our viewers.
Basically, it's very simple. Bank is the business of borrowing money at as lower rate as possible and lending money at as high rate as possible, and therefore maximizing their profit on this transaction. Whereas corporates basically need money to kind of run their businesses. So they can go to a bank, which may charge them, let's say, 8 or 9%. And if they go to retail investors and they can borrow at, let's say, lesser than what they will borrow at a bank, they will prefer going to retail investors or depositors. So corporate is utilizing money for their own purpose. The alternate to corporate is go to another financial institution or a bank to borrow, but the rate may not differ much, and that's the reason why, because you are taking this intermediary out of the equation, because bank is necessarily an intermediary and corporate is using the fund for itself, and that's the reason why corporates may end up giving marginally high returns than what a bank will offer.
How would you look at corporate bonds and FDs as, they're available at different durations. And, different durations have a different interest rate as well that they carry. So if I have to keep in mind my investment objective, if I have to keep in mind my view as well on interest rates, what's available at the bank, because banks as well offer long-term fixed deposits. How would I essentially match that? How do you decide on durations, etc.?
Yeah, so then a very, very interesting question you have raised. And the biggest risk that you run when you are doing a fixed deposit or a corporate bond or a bank deposit is reinvestment risk. Okay, so let's say 1 year back or 2 years back, I did a 2 years FD, and that FD has now got matured. Okay, but I got, let's say, 8% interest 2 years back, and now when I reinvest this money, I'll get only 5.5%. Okay, or 6%, because interest rates have come down. Okay, so in a low interest rate scenario like today, you should basically aim for shorter duration FDs. So 1 year, 2 years, because that 1 year down the line, 2 years down the line, interest rates will definitely go up. When today the economy is in shambles, and that's the reason why RBI came and gave a lot of monetary stimulus, and they reduced the interest rates to kickstart the economy. When the economy goes back and recovers completely, RBI cannot keep the rates at these levels, because it will fuel inflation. So if interest rates go up after 1 year, when this FD mature, there is a chance that you will get a higher return. So reinvestment risk is something that one needs to consider when they are investing, for whether you should invest for short duration or long duration. And the second is the factor of safety. So when I'm investing with somebody for 1 year or 2 years, my money is far safer than when I'm investing for 8 years or 10 years. Because the probability that things can go wrong in 8 or 10 years is higher than they can go wrong in 1 or 2 years. There's a little more visibility in short duration. So if you are investing with, let's say, a bank or very, very large company, let's say an HDFC Limited or a LIC Housing, you can take a very long-term view. You can invest for 6, 7 years, 8 years also. But if you're investing with a company which is not very large, then I would recommend that take a shorter term view, 1 year view or 2 years view or 3 years view, and don't basically block your money for an extended period of time. So safety of your capital and reinvestment risk, these are the two factors which will decide whether you should take a short duration FD or a long duration.
Okay. What percentage of one's portfolio could be invested in corporate deposits or corporate bonds, according to you, depending on, of course, each individual's risk profile, etc.?
So basically, I would say that whatever is the fixed income portion of one's portfolio. So somebody may have real estate and gold and equities and fixed deposit or fixed income. So within fixed income, not more than 20-25% should basically be invested in corporate bonds or corporate deposits. The reason is very, very simple. In fixed income, the credit risk is the most important element when you are investing. Okay, and credit risk basically means that either you will get your money back or you will not get your money back. It's not in between that I'll get partial money back. So diversification of risk is extremely important when it comes to fixed income. You can't invest all your money into one kind of investments. And when, let's say the economic circumstances become such that there could be a series of defaults, like you mentioned in the program in the beginning, there was ILNFS and there was DHFL, and then there were a few more. So if you, let's say, invested all your money into DHFL or ILNFS, sorry, not IFL, yeah, you may have lost substantial amounts of money actually. So putting money into variety of debt instruments, and fortunately in India, there are so many fixed income options which are available to you, right from bank fixed deposit, post office, then you have government schemes like senior citizen schemes, company deposits, you can do tax-free bonds, you can do market-linked debentures, you can do perpetual bonds or debentures. So there are so many options available. So I think it makes sense to diversify adequately across multiple categories in fixed income.
Okay. All right. Well, folks, these are just some options given by Mr. Nath. We'll discuss them in depth. And of course, if you have any questions or queries, we can just take that up as well with Mr. Nath. You can email us on themoneyshow@etnow.tv. Send them in and we'll wait for a while the question queue assembles. In the meanwhile, a short break. Mr. Nath requests you to stay on with us. Welcome back. You're watching The Money Show on ET. Now, we've been talking about corporate bonds, corporate FDs. What are the things you should take care of when investing it? And yes, there are great options to diversify your portfolio. Mr. Nath as well spoke about them in the previous session. Of course, if you have any questions or queries, you can send them in on themoneyshow@etnow.tv. That's our email address. We've already got a couple of questions lined up, so let me take them all one by one. Our first query is coming in from Basavaraj Bhimareddy. He says, I received a lump sum amount after I retired from government services. I invested this amount in schemes like the Senior Citizen Savings Schemes, a PM Vaya Vandana Yojana, Post Office Monthly Income Scheme, debt MFs as well, like Short-Term Fund, Banking PSU Fund. Now, one of my advisors suggested that I invest up to 5 lakh rupees in the fixed deposit of Equitas Small Finance Bank. There is an insurance coverage of up to 5 lakh rupees for FD. So this is a somewhat related topic, small finance bank FDs. Mr. Nath, they actually give a better rate of return, so it's understandable for somebody who's chasing options like these that they would consider an FD from a small finance bank. But what's your view here? And let's keep in mind that our viewer here is retired, so maybe we have to keep his risk appetite as well in mind.
True. No, so small finance bank, as you rightly say, these are all new age banks. They got formed around 4 or 5 years back, and they want to attract a lot of customers. Okay, and therefore they are ready to offer higher returns, higher deposit rates, and this low interest rate scenario has come as a boon to them, because most large banks are unable to give high interest rates in these scenarios, and that's the reason why a lot of people are now looking at these small finance banks for their investment requirements. And but yes, these most of these banks are well managed, and they have strong promoters, adequate capital. And one needs to understand that whether you are a small bank or a large bank, you have to comply with the Reserve Bank of India's capitalization requirements. Okay, and they are very strict. So there's tier 1 capital requirement, tier 2 capital requirement, and they are very, very strict. RBI is very, very strict about it. So if a bank is functioning, one can reasonably assume that it is adequate capital. to support itself. Okay, and so you can go ahead and invest and take advantage of these deposits. And your advisor has actually given a very nice suggestion that go up to 5 lakhs. And the reason for that is that DICGC, which is Deposit Insurance and Credit Guarantee Corporation, actually insures the deposits up to 5 lakh rupees plus accumulated interest. So you can go up to 3 lakh, 3.5 lakh, 4 lakh rupees easily. So your accumulated interest plus your principal is, as long as it's below 5 lakhs, you will get 5 lakh rupees if the bank folds up. So these are good investments.
Okay. All right, let's take on board our next question, which has just come in from a viewer, Mr. K. Kandasamy. He asks, how are corporate bond funds and debt fund of funds better than fixed deposits? Mr. Nath?
Yeah, so very interesting question, and I think since we are discussing fixed deposit, I was waiting for a question like that. So corporate bond funds have been an instrument of choice for people who are in the higher tax brackets. Okay, so let's say you are getting 6% interest from a bank and you are paying 30% tax. You will end up basically receiving only 4.8% after taxation, because 1.8 rupees will or 4.2%, not 4.8. Okay. Whereas in a corporate bond fund, you can get benefit of capital gains and indexation. So you will end up paying very little tax. So if the corporate bond fund is also giving 6%, you will maybe end up paying only 40-50 paisa by way of taxes. So your post-tax return will be 5.5% instead of 4.2%. So for people in the higher income tax bracket, corporate bond funds make more choice than fixed deposits. Okay. And the second advantage of corporate bond fund is that rather than you picking and choosing a fixed deposit or an investment with a corporate, because you don't have enough information, you only rely on the name of the company and the credit rating. Whereas when a corporate bond fund is investing in the same corporates, they are doing far higher level of due diligence, and diversifying across far more number of instruments. So it becomes inherently very safe. So in the last 20-25 years, since this corporate bond funds, mutual funds, which are corporate investing in fixed income, corporate bonds have come about, there's not been a single case, and there'll never be a single case where a fund folds up and is not able to pay back, because it's diversified across so many instruments that event can never happen. So instead of you diversifying, you can actually use these vehicles to diversify your portfolio and also get higher post-tax returns. Okay.
Okay. Yes, it's a great way, to invest and get exposure into corporate bonds. That's why corporate bond funds. Incidentally, in the last couple of months as well, we've seen nice net inflows come into this category in particular, especially in the last couple of months. Debt funds in general have been more popular than equity mutual funds in terms of net inflows. Corporate bond funds have as well been topmost among the debt fund list. Mr. Nath, on that note, we're out of time, so we let you go. Thank you so much for joining us today on ET Now and, answering our viewer questions and queries. It was great to have you with us. And folks, you can catch this episode on ET Now's YouTube channel. For now, we'll take a very short break.